Hello, everyone, and welcome to Girard's Monthly Market Update. I'm Senior Vice President and Wealth Advisor Jim Jacobson, and on the other side of today's webcam is Chief Investment Officer Tim Chubb. Thank you for joining. So, over the last few weeks, we've begun to get all kinds of updated economic numbers, and some of them are grim and gory, and really they're not shocking. This is what we knew was going to happen, but the fact is we now have the numbers in, so that's a good baseline to set going forward. Unemployment has reached the highest level since the 1930s. Manufacturing has pulled back. The service sector has really ground down to a halt as things have closed, and yet the markets continue to go higher. So, Tim, when we look at this market, I sort of think of reopening. It's not going to be so much like just jumping in an elevator going straight to the top. It's going to be more like climbing Mount Everest. But the market seems to be moving higher quickly. So, tell us what's happening with the economy and the markets.
Yeah, the market's been acting, sort of like we're jumping on an elevator and getting right back to a more normal economy very quickly. And when we had recorded back in March and April, it was all about fear of the market and whether this would be a biological crisis that would turn into a financial crisis. But so far in May, it's been all about fear of missing out or FOMO. And after the bear market hit its low on March 23rd, the S&P 500 has climbed about 30% or about close to 60-70% of the retracement of what we've seen in the decline, despite horrible economic data, job losses to the tune of 20 plus million, and now an unemployment rate of about 14.5%. So when we look and take a step back, I really think there's sort of three symptoms from this rally. One has been the Fed and the CARES Act, obviously providing support in both monetary and fiscal policy. Second has been, declining infections, and the infection rate for COVID-19 has continued to decline pretty meaningfully across the United States. Then the last thing has been, we call TINA, and there is no other alternative for as far as looking at stocks versus bonds. The 10-year Treasury is at about 75 basis points or 0.7%, and so investors feel a little bit more comfortable paying a premium for those stocks during this time. But this has been a very unusual rally. The market has really lacked breadth. We've seen about five companies now compose 21% of the S&P 500 and contribute 35% of that return off the lows from March 29th. And so when we actually look at the market in context, the economy, I think most can say that the market is not necessarily reflecting the true economic conditions, but is the market really reflecting the actual average company within the market? And when we look under the hood, when we're recording this, the S&P 500 is down about 10% year to date, but the median company is actually down about 18%, with the bottom 20% down on average of 45% year to date, and the top 20% actually positive so far this year. So I think as we look moving forward, ultimately for the market to move higher, while the worst is probably past us, the best is also probably past us. And now it's really going to be focusing on progress for the antiviral remedy and the vaccine, hopefully later this year.
So it makes me think of the old phrase 80-20, but in the case of the S&P 500, maybe it's more like 5 to 495, those top five stocks leading the other 495 kind of lagging. And that makes me think of the whole debate that goes back and forth in the market between growth and value, where some people say value is the way to go. You want high dividend payers for the long term. And other people say, no, 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 you want growth. That's where your future is. And I think of Warren Buffett, the classic value investor, shopping for companies that are high cash flow generators at bargain prices. And yet, looking at Berkshire Hathaway, the largest holding is Apple, which is certainly more of a growth stock. So, Tim, give us an idea of the current scenario between growth and value.
Yeah, growth and growth stocks is probably growing more quicker than my hair is. It would be like Rapunzel, come June. But growth has outperformed value really significantly so far in 2020, really picking up where it left off in 2019. Since January 2019, growth has outperformed value by about 35%. Even in a market environment where the S&P grew by over 30% last year, and then at a point in time earlier this year was down over 35%. So I think this record bifurcation between growth and value is really reflective of the environment. And when we're in a growth-starved world, and growth is going to be low and slow moving forward, interest rates are going to be low and not really moving higher anytime soon, investors feel more comfortable paying a premium multiple or paying, more for a growth stock that's achieving revenue and earnings growth above what the average company in their peer group or within the market is able to achieve in this environment. And so I think it's important to have diversification during these times, despite wanting to chase some of these growth stocks. I think it's important to have some balance with value. And if we were to go into an environment later this year where the growth expectations meaningfully accelerate because we get a better idea of what the recovery would look like in the second half of either 2020 or early 2021, then I would expect value stocks to outperform. But I also expect growth to continue to be, predominantly a better performer in this low growth environment longer term.
Tim, thank you for those comments. I think you're exactly right. The market's not just going to tell us what way to go. Growth, value. It's going to be a game of having a well-rounded portfolio and having the right mix going forward long term and not chasing return short term. So for those of you watching today, we encourage you to join us on our website, meetgirard.com. That's MEETGIRARD.com. You'll find links to our experienced investment team as well as our investment and financial planning services. So thank you for joining us today, from our homes to your homes or your offices, your yachts, your helicopters, wherever you're joining us. We appreciate you and look forward to talking to you again next month.